Welcome to Tulane University's Burkenroad Reports video series. My name is Alex Moran, and today I will be discussing Hornbeck Offshore Services. Our team of analysts that covered Hornbeck this year were Mohammed Ayush, Doug Kelso, Ying Fu, Alex Moran, and Marlon Sills. In this video, we will be presenting a company overview, a breakdown of the upstream and downstream segments, a market overview, short-term and long-term outlook, as well as a talk about our site visit and valuation techniques. Headquartered in Covington, Louisiana, Hornbeck is a leading provider of technologically advanced new generation offshore supply vessels that support the offshore oil and gas industry. Within the marine transportation industry, Hornbeck competes in the upstream and downstream segments. In the upstream segment, Hornbeck offers support and logistics services through its fleet of offshore supply vessels and multipurpose supply vessels. Hornbeck currently operates one of the largest and youngest OSV fleets in the industry with 51 vessels. In addition to its 51 OSVs, Hornbeck operates 4 multipurpose supply vessels. MPSVs are substantially larger and more specialized than its OSVs and are used for more complex deepwater projects. In the downstream segment, Hornbeck owns a fleet of ocean-going tugs and double-hulled barges designed to transport refined petroleum products and crude oil to marketing and refining companies along the eastern seaboard. In the upstream segment, Hornbeck's core focus is on the geographic markets of the Gulf of Mexico, Brazil, and Mexico. The company has a total of 40 OSVs split between these three markets. The company also operates 5 OSVs currently being contracted by the United States military along the U.S. coast, as well as 2 OSVs operating in Qatar, which were inherited from a previous acquisition. In 2011, Hornbeck's upstream segment provided for 98% of its total operating income, while the downstream segment provided only 2% of the operating income. Hornbeck's revenue from its downstream segment has decreased because the company has focused on the high-growth, new generation OSV industry. As a result, the company has expressed interest in selling off its downstream segment. Hornbeck is one of the top operators of new generation OSVs worldwide. Hornbeck operates 6% of the worldwide market and is a top 3 operator within each of its 3 core geographic markets. The company currently controls 23% of the Gulf of Mexico market, 6% of the Brazilian market, and 14% of the Mexican market. Since the 2010 Deepwater Horizon incident, the United States government has been slow to issue deepwater drilling permits in the Gulf of Mexico. As a result of the lack of drilling, demand for Hornbeck's vessels decreased and the company's performance suffered. However, Hornbeck's stock price has slowly been climbing since falling below $15 in the summer of 2010. Issuance of new deepwater permits picked up significantly in the second half of 2011, and as permits look to increase into 2012, we look for Hornbeck's stock price to do the same. The trend in oil exploration and production is to drill deeper and deeper wells. Because drilling deeper wells is more complex and requires more material, E&P companies require bigger and more technologically advanced supply vessels. Hornbeck is looking to take advantage of this trend by entering into a new ship build program for 16 new generation 300 class OSVs. These 300 class vessels offer double the deadweight tonnage and more than double the liquid mud capacity than 200 class vessels. In fact, one of Hornbeck's 200 class OSVs could fit on the deck of one of the new 300 class ships. These 300 class vessels are to be delivered by the end of 2014 and will be able to capture greater day rates for Hornbeck. On February 17, 2012, our team of analysts visited Hornbeck Company headquarters in Covington, Louisiana. We met with Jim Harp, Executive Vice President CFO, and Potter Adams, Manager of Corporate Finance. Mr. Harp spoke about the new ship build program, specifically about how the new 16 vessels will allow Hornbeck to take advantage of a drilling industry that is currently undergoing a flight to quality. To come up with our 1-year target price, we used a weighted average of a price-to-earnings model and discounted free cash flow model. For our price-to-earnings model, we used Hornbeck's historical quarterly PE ratios to predict the ratio going forward. We decided to use the company's historical rates because Hornbeck lacks a true peer group, and we felt the company's past PE ratio would be a better indicator of the future. Our discounted free cash flow model forecasted Hornbeck's free cash flow out 10 years and estimated a terminal value. These cash flows and terminal value were then discounted back by our calculation of the company's weighted average cost of capital. The main driver for Hornbeck's cash flow was upstream revenue, which we projected using a regression model. The variables used in the regression model were upstream vessels and average upstream day rates. The combination of the price to earnings and discounted free cash flow methods gave us a target price of $47, an 8.1% increase over the stock price at the time of the report. Based on our valuation, we have given Hornbeck stock a rating of market perform. This concludes our video report on Hornbeck Offshore Services. On behalf of all of us at Tulane University and Burkenroad Reports, thanks for watching. The Burkenroad Reports are produced solely as part of an educational program at Tulane University's Freeman School of Business. The reports are not investment advice, and you should not rely on them in making any investment decisions. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.